Hi, good afternoon, everyone. This is Ian Gendler, Director of Research at Valueline. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. Lastly, as an added bonus, attendees will have the opportunity to receive an additional stock recommendation. I will provide details at the end of the presentation. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 that are included in this service. Valueline does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, it is vital that we have a firm grasp in regard to the current economy and stock market. I assume most of you would agree, especially now, as we navigate trade wars and other potentially disruptive events. The following content was written by Harvey Katz, Valueline's managing editor and chief economist. The spring warm-up, often an annual ritual for our economy, may not take place this year. In part, this is because the first 3 months of 2019 brought a jump in exports and a surge in inventories, two trends that helped propel GDP growth forward by a solid 3.2%. In all, this strength was consistent with the average level of growth posted in the final 3 quarters of 2018. However, this early surge may be unsustainable, as the gains in exports and inventories likely will reverse, especially with the trade war with China now raging. Also, there's no assurance consumer spending will pick up the slack. Such outlays slowed last quarter, and April brought a 0.2% dip in retail sales. Additionally, our deteriorating trade relations with China will exact a toll. The question is just how severe that toll will be. For now, we sense the respective sides will work towards a détente of some sort. However, enough hard feelings may persist to prevent a full meetings of the mind. Meantime, the economy should press ahead in 2019, even without progress on global trade, as the fundamentals appear sufficiently sound to prevent a recession this year. But progress will be more labored than in 2018, especially if the trade dispute intensifies and new levies and countermeasures are imposed. These are the sorts of international trade risks our economy hasn't faced since the 1930s. In a worsening trade backdrop, business investment would suffer, industrial production would falter, retail sales would slow, and the jobless rate, now at a half-century low, would rise. The recent frenetic action on Wall Street, in which sharp up and down moves have occurred on a regular basis, highlights what we sense are economic risks. The long economic expansion has been consistent, if uninspiring. Inflation has been muted, interest rates have stayed low, but with occasional increases, and profit growth has been steady. If this backdrop has been consistent, it also has been unexciting. But that is likely what has helped the stock market fashion in an unprecedented decade-long joyride. In truth, Wall Street doesn't like surprises or excesses, and this economy has had few of either. As for the market, the Dow Jones Industrial Average, which peaked above 14,000 last decade and would fall to just over 6,000 in the bear market of 2007 to 2009, would come roaring back and shatter record after record, soaring to just under 27,000 last fall. It has threatened to top that level on several occasions in 2019, only to fall back each time. Meanwhile, records again have been set by the S&P 500, a broader-based benchmark, and the NASDAQ, which is home to some of the highest profile technology names. Now the question is, where do we go from here? The stock market, with a price-to-earnings multiple of 16.9, is certainly not cheap. However, with the fundamentals still supportive, that is, with the economy projected to continue growing modestly, especially if we see a lessening in global trade tensions, with inflation likely to remain under control, and with the Federal Reserve seemingly on board with accommodative interest rate policies, the market is not overly expensive either. As such, and with the continuing tendency to buy the dips, we could see further progress by equities in the months to come. In conclusion, we think the accumulation of quality stocks with growing dividends is a prudent investment approach at this time. Harvey's commentary, and especially his conclusion, can help us in our search for one stock to buy right now. We can use these details to put together a strategy, and thankfully, Value Line subscriber tools will enable us to do just that. Before we start our formal search, please note that we are currently on our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries and analysis, as well as general interest articles that are written by our research team. Examples of such content are analyses of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I am now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our home pages for our monthly stock selection services, as well as our investor tools. As you know, the point of this presentation is to find a stock to buy right now. So let's go to the screener and get started. This tool can also be found via the Find Ideas tab at the top. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. Let's start with the two factors that Harvey Katz mentioned in his conclusion. Focus on quality stocks with growing dividends. There are a load of metrics that can be used to assess quality and stability. One that I recommend is Value Line's safety rank. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For more information, I encourage you to peruse our ranking system guide, which is available via the investment education section of our website. In addition to guides, users can access a glossary of terms and articles written by our analysts about basic financial strategies and other important topics. This is all free of charge. So to start, I click on the safety rank field, and I want to focus just on the stocks ranked 1. These are the most financially sound companies, and their stocks have a history of relative stability. It is worth noting that of the nearly 6,000 stocks in our database, only 130 or so garner this top rank. Now let's add dividend growth, and I'm going to use the past 5 years. For the low bound, I'm going to use 5%. This shows the companies that have increased their dividend payouts by at least 5% annually over the past 5 years. Growth is important, but I also want to consider the current yield. Let's add dividend yield and set the low bound to 3%, which is nicely higher than the current value line median of 2.2%. A sizable dividend yield should also offer some protection in the event of a market downturn. With just those three fields, we're down to 19 stocks. According to our variables, they are high quality with growing and meaningful dividends. And there's the 19 stocks, there's the list. However, I also want to make sure that their businesses are expanding and that there is some upside. Commonly, these kinds of searches will only surface slow-growing, mature companies. So let's add one more field to make sure that these companies are not stagnating, and I'm going to tap the projected 3 to 5 year earnings per share growth rate. This is a good time to mention that Value Line is one of very few research houses that provides financial estimates that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. I'm going to set the low end to 8%, which is a solid expectation. Seven results. All of these fit the bill of high-quality stocks with growing dividends and earnings upside. They may well fit nicely in your portfolio depending on your strategy. However, only one can be today's one stock to buy right now, and the victory goes to United Parcel Services, ticker UPS. Before I dive into UPS, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized stock report. Once you alter the presentation to your liking, you can save the changes from the slide action bar. The next time you come to this report, it will look the way you set it up. You can also apply these changes to other equities. I assume everyone is more than familiar with United Parcel Services. The company is the world's largest air and ground package delivery carrier. More corporate-related information is available in the Business Overview module. Our digital reports possess a great deal of information and analysis, and I can't cover all of the useful modules. However, I do want to discuss a few features that highlight UPS's favorable prospects and investment merits. First, the valuation module shows the annual historical performance of the company along with our estimates for 2019 and 2020. A quick scan shows that revenues, profits, cash flows, etc. are all increasing at favorable rates. We expect that growth will remain strong for many years to come, which is reflected in our 3 to 5 year projections module, which is just to the right of valuation. As you can see, we project that UPS stock will trade between $155 and $185 by the 2022-2024 timeframe. Its current price is around $95, which suggests plenty of room to run. And as you can see, we project annual total return of between 15 and 19%. Speaking of performance, let's take a look at Value Line's newest feature, which is only available for subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict a stock's price over an 18-month horizon in terms of a range. In addition to the high and low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely potential profit. The larger the percentage, the greater the possible price appreciation. For more information, all you need to do is hover over the Explain. For UPS, the midpoint of our 18-month range is $132, or 40% higher than the current price. 40% at present is far higher than the average of all stocks that we track. According to this variable, UPS should easily outperform the broader market over the next 18 months. Clearly, from a numbers standpoint, there is a lot to like here. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available using the button here on the right. We just published a new report on UPS. Let's see what our analyst has to say in the commentary. Many subscribers consider this the most important part of our reports. Editorial analyst Kevin Downing is bullish in regard to United Parcel's prospects. Here is an excerpt. Although first quarter results were unexciting, the situation should improve. Management stuck to its 2019 adjusted earnings outlook range of $7.45 to $7.75. Second quarter operating profit is expected to grow in the mid-single digits, and the bottom line should come in flat, largely due to planned pension financing costs and the opening of the new highly automated warehouses. These next-generation sorting facilities should be 30% to 35% more efficient than traditional ones. 2, 80% of the network is expected to be using some sort of automation technology by the end of 2019. Earnings results ought to improve in the third quarter, owing to one additional operating day, gains from a voluntary retirement plan, benefits from the automation investment, and some commodity headwinds in 2018 that are not expected to repeat. As for the stock, they are a solid all-around choice. We like the company's decision to focus on small and mid-sized businesses in growing markets like healthcare and e-commerce. Providing these companies with the ability to outsource fulfillment and shipping to UPS should help them better compete with e-tailers like Amazon. Although U.S.-China trade relations add uncertainty, the shares still have our highest safety rank and a solid dividend yield. I personally want to add that although UPS would probably be hurt by a prolonged trade war, much of that downside appears to already be priced into the stock. If we take a look at the chart, and as we mentioned, it's trading at around $95. Its 52-week high is $125. All told, we think UPS shares are inexpensive from a variety of value line metrics, and the current price represents a good entry point into this high-quality issue. In sum, United Parcel Services is today's one stock to buy right now. This marks the end of the formal presentation, and I will now tackle your questions. All right, first question, and this is actually on our one-page reports. Our new reports come out Monday morning. What date is used when showing stock prices and yields? Okay, the price at the top of the report, which the PEs and the yields are based on, it is the previous Tuesday's closing price. Next question, I assume analysts can own securities they do not cover. Correct. The analysts are free to purchase stocks they don't cover. However, they can only buy them at certain points in time. When we're about to put out a new report or we're changing the rank of a stock, they are not allowed to purchase it. That information goes to our subscribers first before trades can be made on personal accounts. Next question is, do you guys do any back testing on your target price projections and why you may have gone awry? Yeah, so to give you an example, we do back testing. And for our new 18-month target price range, we obviously didn't develop it overnight. We've been testing it. We've been tweaking it for quite some time before we rolled it out to subscribers. And doing back testing, we were able to show that somewhere between 70 and 80% of the stocks would fall into the range 18 months later. As for reasons why things go awry, obviously the longer the range, the more time there is for things to get out of whack. For instance, if we made estimates in 2006, I don't think, well, I know I was working here at the time, we weren't forecasting the financial crisis where the Dow would lose 60% of its value. So those are the kinds of things that really make our estimates, incorrect or way off. Significant market troubles, or of course, company risk. I personally cover Boeing. In my near-term estimates, I wasn't factoring in 2 crashes and them having all the problems they're having now. There's some things you just can't forecast. I do not see the same information for UPS on Value Line website as you are seeing. Do I need to have a paying subscription to see the basic info like safety rank and financial strength? We do provide quite a bit of information to non-subscribers. This includes basic things like stock price, market cap, etc. Things like safety and financial strength are proprietary variables that do require a subscription. That said, we do provide our full research on the Dow 30 for free. Next question, why are both FedEx and UPS prices not holding up in this market? I think it is trade related, but one of the reasons why I like UPS is I think most, if not all, of the bad news is already reflected in the price. As I mentioned, its 52-week high was $125. Now it's $95. I think the bad news is already in. With trade wars, what are the factors that should be factored in? Obviously, there's quite a lot. Most simply, do they actually come to an agreement? And then what are the terms of that agreement? Those are things I really can't speak to now. I just hope that U.S. and China are still at the table and they're not terribly far apart on a deal. Although I personally don't think that they will come to terms within the next few months. I think this will be a prolonged negotiation. Next question. The small and mid-cap stock reports show a total shareholder return at the bottom right. Any way to see this information with UPS? Yeah, we show the total returns in this box right here on the PDF. So as you can see, over the past year, this stock is down 3.4%. And these are total returns, they're not annual. And then for the 5 years, they're up 25.2%. And we compare that to the Value Line Arithmetic Index, which is the 1,700 stocks that we track. Why do you think 4 Canadian banks were on your final 19 list? Simple answer, because of the criteria. We were looking at only the safest companies with dividend growth. Canadian banks almost always fit that bill. They are certainly a place to invest if you're looking for stability and safety. And of course, yield. Let me just scan through and make sure I didn't miss any other questions. After reviewing this again, as I mentioned, this will be posted on our site within the next 48 hours. If you have any further questions, you can feel free to email me. Once again, my name is Ian Gendler, and my email address is igendler@valueline.com. That's the letter I, GENDLER @valueline.com. All right, one more question came in as I mentioned that. It's not a question, I guess, but another viewer mentioned that Canadian banks will have a foreign tax on dividends. That is correct. All right, that looks like all the questions. Like I said, you can email me if you have any others. In closing, as promised, Value Line is making available an extra recommendation of a stock that you can consider for purchase. It is only available if you call 1-800-VALUE-LINE and press 2 to speak to a Value Line representative. Please mention code 1905-BONUS. That's 1905-BONUS. You will also receive a bonus month of service if you choose to buy or renew any of our annual products. But no purchase is required for the bonus recommendation. All right, well, that concludes today's webinar. Thank you so much for attending, and have a great day.